We are turning the spotlight on health insurance stocks in the U.S. A number of them came under pressure yesterday after Humana warned that they are going to see higher costs and are forecasting anemic enrollment. Investors have become increasingly worried about whether health insurers are adequately prepared for the rising expenses that they are facing. They have to pay those out. To understand what's going on beneath the surface, let's bring in Lance Wilkes, senior equity analyst at Bernstein, who covers the space. Humana was warning on medical costs, Lance, but earlier this month, UnitedHealth was kind of kicked things off with these concerns. And I wouldn't say they're new, right? They've been bubbling up under the surface. Medical costs are rising for these insurance companies.
Hi, yes, that's right. You know, in 2023, I think we really had an unexpected, from the managed care company's perspective, rise in utilization. I think that was really kind of an unwind of COVID, and there wasn't enough labor supply in hospitals and doctors' offices to take all the demand that had come out of COVID. And in 23, you saw a real sharp increase in payrolls in those sectors. And the managed care companies hadn't forecasted that with their 2023 pricing. And so that utilization rise was really unexpected and blew through medical loss ratio estimates. Humana and United both gave pre-announcements back in June. And then as we're kind of wrapping up the 23 year, I think there's no extra cushion in these companies to cover any sort of unexpected costs. And so as we get some COVID spikes, some flu, some RSV upticks in utilization here in the fourth quarter, that just is flowing straight through as misses in the fourth quarter for United, likely for Humana now. I think as you pivot to 2024, the pricing environment, you know, this has been known now for a while. So in certain segments, like the employer health insurance segment, I think this is going to be very effectively priced for in 2024. Other areas like Medicare Advantage, I think that's an area where there was aggressive pricing still by a number of these managed care companies, and they forecast, for example, United had forecast a rising medical loss ratio for next year, nearly 100 basis points or a percent, to reflect that sort of underpricing in 24 that they'll need to improve in 25. And I'd say that's an industry thing. That's not just United. And
is that how you're parsing out the winners for 2024 versus the laggards? You've got buys on UnitedHealth, Centene, Elevance, Cigna, and then holds on Humana, CVS, HCA Healthcare.
Yeah, that's right. You know, I think the key variables there are Elevance, Centene, which would be probably my top two picks. Those are companies that are much more exposed to the employer and Medicaid space for Elevance, and the Medicaid space for Centene. The Medicaid redetermination, or kind of kicking people off Medicaid from the COVID public health emergency, is ending. And so that should be a resumption of growth for that segment. That should have effective pricing, and employers should have very attractive pricing from a managed care perspective next year. United is a very diversified company, so they actually also have employer and Medicaid, but they do have the exposure in Medicare Advantage that kind of, you know, is an offset and one of the things that probably causes a little less upside in that name compared to the others. And then Cigna is more of a PBM, and that's a space that historically I've been relatively bearish on, but have really shifted over the last year, because I think that the regulatory impacts of legislation are going to be a lot less than the valuation impacts. And GLP-1s, which is obviously a big story out there in the marketplace, and the growth in innovative drugs is something that's going to benefit PBM. So that's why we got a buy on Cigna.
You've been one of the few people that were neutral on Humana, which worked out. It's the stock is at around a 2-year low. At what point do you say enough is enough? What would you look for in terms of signs of a turnaround that would get you more excited about the stock?
Yeah, that's a great question. So with Humana, I would say, and this, you know, parts of this would apply to CVS, which we're neutral on as well, which is the number 3 Medicare Advantage player. I think the Medicare Advantage segment is attractively priced at this new low level. I do think there's headwinds, and you're not really going to see benefits at an operating level until you get into 2025. But I think the concerns that investors have are kind of, you know, threefold. One, that you're going to see rising utilization through 2024, and these managed care companies are going to be behind that, and will consistently be behind that for year after year. We're not seeing evidence of broad rising utilization like we saw in 2023. Payrolls really accelerated, so labor supply really accelerated over the course of 2022. It's been really stable from 23 through the beginning of 24 here. So we think that's really important and will lead to a relatively stable utilization environment. So that sets the stage for some improvement in these Medicare Advantage names. From a pricing standpoint, Medicare Advantage has been aggressively priced for the last decade. At this point, you've really seen a consolidation in the space. New entrants that capital markets were financing to get into the space have really had to pull back. Companies like Oscar and Bright and the like, and they're out of the Medicare Advantage market. Smaller players in the low rate environment we are in are going to have a difficult time competing. And so I think you're going to see Humana, United, CVS, and Elevance as the big winners in Medicare Advantage, and that small grouping will allow for more disciplined pricing. And then we really think that growth, while anemic in January of this year for a couple of these companies, the growth drivers still really work. There's a slowdown in growth. We're about 50% of Medicare that is now in managed care. We think that can go up to 75 to 80% still. So we've got a couple decades of growth still left in this. We think maybe the growth rate in membership might drop from 8% to 6% over the coming 5 to 10 years. But overall, that's still very solid growth. And at these valuation levels, that could be really attractive. I think the impediments to getting excited are, Humana needs to come out with their guidance for 24 and 25 still. They'll likely do that next week on their earnings call. But our estimates are below their current guidance in both of those instances. So there needs to be still a more comprehensive resetting of expectations. But we do like the long-term setup for the company.
Before I let you go, it's an election year in the United States. Is that a factor in how this is going to affect these stocks?
Yeah, I have a little different view than most of the portfolio managers I talk with on this. I would say that there's a lot of money sitting on the sidelines because it's an election year, and there has been concern throughout the second half of 2023 that people didn't want to invest in this sector because it's an election year. I think in general, only a couple election years have been bad for managed care: the 2008 election and then 2019 primaries. This year, with Biden running, I don't think you have any sort of big valuation shock risk that you're going to be exposed to. And we'd expect as you get greater certainty that it's going to be Biden as the Democratic nominee here, and regardless of who the Republican is, you're going to see money coming back into the MCO space. So, we wanted to be ahead of that, and consequently, we're positive on it for the whole year, recognizing that money will flow in as we get closer to through the primaries and closer to the convention.